Get your free copy of the complete tutorial at www.teachucomp.com/free. Now that we have covered how to make decisions, we will include some other tools for financial analysis and decision making. While this is not a comprehensive list, this is a list of some of the more important formulas and ratios. This list is a set of formulas for determining liquidity. Liquidity ratios measure the short-term ability of a company to pay its maturing obligations and to meet unexpected needs for cash. A commonly used measure of liquidity is the current ratio. The current ratio is current assets divided by current liabilities. The higher the number, the more liquid a company is, meaning that they are more able to pay the needs for cash and maturing obligations. This is an important measure for investors, since a company with more liabilities than assets is less likely to receive future loans. Other liquidity ratios include working capital, current cash debt coverage ratio, inventory turnover ratio, days in inventory, the receivables turnover ratio, and the average collection period. Solvency ratios measure the ability of a company to survive over a long period of time. The debt to total assets ratio is an important ratio in this sense. This indicates the extent to which a company's assets are financed with debt. Other important solvency ratios include the cash debt coverage ratio, the times interest earned ratio, and free cash flow. Profitability is another important aspect to analyze in a company. An overall measure of profitability is the return on assets ratio. This is computed by dividing the net income by average assets. The return on assets ratio indicates the amount of net income generated by each dollar of assets. Therefore, the higher the return on assets, the more profitable the company. Other important ratios for profitability include earnings per share, price-earnings ratio, the gross profit rate, the profit margin ratio, the asset turnover ratio, the payout ratio, and the return on common stockholders' equity. Recall that variances are the differences between total actual costs and total standard costs. These formulas are important for managers to control costs. They include the materials price variance, materials quantity variance, labor price variance and labor quantity variance, and the total labor variance. Understand that these ratios and formulas are important for financial analysis and for managers to make decisions. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.